Well, our next guest says the market is entering the chill zone, but he is ready to buy a December dip. Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, great to have you with us. I'm going to first ask you a question before we get to the December chill part of the conversation about what happens. At what level are you concerned about that 10-year yield from a market standpoint?
Is it 1%? Is it 1 point? I have no idea. Already we're talking about it, which, to the panel's point. What I do want to say, though, is I think that if you do get a nuance where the Fed comes in and starts to aggressively buy the treasuries, I don't know that that would be such a bullish move in that it would kind of hit the cyclical trade, which is what has been driving things for the last month. It's really been an extraordinary month. And just listening to everybody, the backdrop is kind of how it's been prescribed. You have an extraordinary level of excess liquidity. And at the same time, you have this synchronized global recovery where, remember in 2011, Mel, where the ECB raised rates into the teeth of the crisis? You're not going to get that this time. You have a true synchronized monetary and fiscal stimulus globally that's at the same time as this beginning of an economic recovery.
So it would be negative for the markets, is what you're saying. Opposite of what Guy.
I don't think it'd be great for the cyclicals. I think the reason that the market is set up for a chill. And by chill, I'm not looking for a big drop. I just don't think up 20% on the Russell 2000 in a month, and that's been my framework, is that's my favorite area. But up 20%, history shows generally whatever you get after that, which could actually mean upside for December. At some point, you're going to buy it better. And that was the purpose of the note, was you've had such an extraordinary run. I would much rather buy into weakness. And to give you an idea of how it's happening, despite the headlines, Mel, the percentage of S&P 500 components trading above the 10-day moving average when we put out our initial thought that you were going to go into this kind of quiet period, you had on November 11th, 90% of the S&P was above the 10-day moving average. Today it was 66%. So even though you've had the indices kind of grind to new highs and really rally, the average stock has been pulling back a little bit.
Big Tony, thank you for joining us.
3,700 or thereabouts.
Guy, why don't you go?
Go ahead, Guy.
I'm sorry. I apologize, Tim. Tony, I'm sorry. I was going to say we're at 3,700 in the S&P 500. What's a logical resting place or logical support level? Dan's talked about, and I've mentioned it, 3,400 seems logical. Is that too far at this point?
An algorithmic trading at the end of the year so what happens in a pause or a correction or a consolidation is it comes out of nowhere. It's not COVID. It's not the things that you can anticipate. When you have such bullishness, remember a month ago you were down 8%. Less than 10% of the S&P were above their 10-day moving average. You had the election right in front of you. You hadn't had the vaccine news yet, so you had the second wave about to punch you in the face, and nobody was bullish. That was the time to buy. When you get into a whoosh like that, we came on the show and did that. The time to not chase is now. So, Guy, I don't know if there's a quote-unquote level that I'd look to be a buyer. It's really a framework, and the framework for me is something I've talked a lot on the show about. When the percentage of stocks above the 10-day moving average drops into single digit, meaning more than 90% are below the 10-day moving average, in a bull market, that's enough. But to me, again, I've said it for 4 months, you cannot, this level of excess liquidity and at the same time having this global recovery, that's why these cyclicals have been rallying. They're already discounting that higher yield and that better recovery.
But just to clarify, Tony, because I'm not sure if you put the number associated with the chill. I mean, it sounds really more like a breeze, a 3 to 5% pullback.
3 to 5%, yeah. We've already had, so the market, Mel, is acting very much like it did in the fall of 2009 after the 50% run into August of that year. You had 3 corrections that ranged between 3 and 7%. The 2 we've already had, which were the September swoon and then the whoosh that we had at the end of October before the election, they were a little bit bigger, between 5 and 10%. So the third one could just be a minor one that sets the stage for the next leg higher. So I certainly don't want to come across as, wow, the market's going to get blasted here. You just have excess enthusiasm. You have an extreme overbought condition. and everybody's kind of jumped on the bandwagon of this global recovery trade.
Right.
And that's usually when it's time to just pause and wait for your better opportunity.
Tony, thank you. Tony Dwyer, Canaccord Genuity. By the way, you can read more about analysts' year-end in 2021 calls on our website. Head on over to cnbc.com/pro to sign up. Dan Nathan, a 3 to 5% pullback to remedy an extremely overbought, overenthusiastic situation in the market seems to be nothing. I mean, that would seem like a major victory.
Yeah, well, it seems fair, and it's actually, and I think I mentioned this the other night on the show, I mean, I would go a little deeper than that. I mean, you have room down, Guy was talking about 3,400, maybe a little below that, and you have the setup, which is really a good multi-month base into the new year. You know, I don't really think you want to get too far ahead of yourself with this extreme positive sentiment right now in December. I think that's going to pull forward some performance at least early next year. And I'll just take you back to 4 years at this time. You know, the world was convinced, or at least the investment community was convinced, that U.S. equities and risk assets related to the U.S. were a buy. Everything went up for a few months. Equities were the ones that really were the stalwart, and they kept on going. I just kind of feel like when you think about where we are and what we have to contend with and what we don't know about the vaccine and when our population, when the global population is going to be inoculated, I just think that there should be a little bit more fear in the markets right here, but you might have this seasonal trade. I just don't think you want to see equities close at the tippy-tip top after a year that we've had in 2020. It might set up for a very nasty Q1 in 2021.
All right. We have got an earnings alert for you on CrowdStrike. Check out the shares. They are soaring after earnings. Our Kate Rooney joins us with the details. Kate.
Hey, Melissa. Yeah, shares up more than 12% after a strong third quarter for CrowdStrike. The cloud cybersecurity company beating on the top and bottom line and issuing better than expected guidance for the upcoming quarter. CrowdStrike hit a record in annual recurring revenue. That's a key metric for these subscription software businesses. That came in just shy of $1 billion. As Andy Nowinski of D.A. Davidson put it, there is nothing more important than ARR. CrowdStrike, as he says, absolutely crushed that estimate for the quarter, which could be indicative of accelerating share gains. The conference call also just getting underway here. CEO and founder of CrowdStrike, George Kurtz, saying the quarter was driven by demand and strength in multiple areas of that business. He highlighted 87% subscription revenue growth and record new customers. The company provides cloud-based security for roughly half of the companies in the Fortune 500. Brent Thill of Jefferies pointing to security as a growing priority for those companies in a work-from-anywhere environment. Melissa, back to you.
All right, Kate, thank you, Kate Rooney. And just to right on that point, Piper had its survey out, and they actually found that among the survey participants who were buyers for companies, they said that this was a category that they would increase spend on. So CrowdStrike would theoretically be that beneficiary for work from home. Tim Seymour, up 81% year on year in ARR. That is staggering.
It is, but part of the reason the stock's done this is one of the things Kate referred to in terms of the strength of their growth within the Fortune 500 and that the customer base, you know, people wanted to see this with a lot of the software-based companies, especially those, even Palantir. But when you get back to CrowdStrike, this is a company who is truly making themselves essential within the Fortune 500, and that's where I think there's still a lot of growth. I hate the valuation. I don't chase it here. Those are fantastic numbers, but that's the story here, and certainly the story around security. That's going to continue to stay hot. Piper's right.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.